Welcome to the Thursday edition of the Tech Stocks Daily Podcast, where we unpack the hottest happenings in the tech market. Today, we've got Apple navigating privacy brawls and massive shifts in investment strategies, while Symbotic tries to mop up a financial slip-up that's triggered lawsuits left, right, and center. Meanwhile, the trade desk is living its best life with a stunning 77% stock climb, yet its towering valuation has investors buzzing. And as if that wasn't enough, FIVN finds itself tap dancing in legal waters over disputed financial claims. So buckle up, tech enthusiasts, as we dissect these wild corporate sagas and unveil what it could mean for your investments. All right, folks, let's dive into the juicy Apple news buffet that's been dished out today. Apple, that seemingly untouchable titan of tech, has found itself in quite a few headline-grabbing situations, and we're here to serve it all piping hot. First on the menu, we have an in-depth analysis comparing Apple's performance within the technology, hardware, storage, and peripherals industry. Apple's key identifiers show some fascinating trends. The price-to-earnings ratio of 40.8 might indicate undervaluation relative to the industry norm, signaling potential investment values to those hunting for a gem in the stock market rivers. However, their high price-to-book and price-to-sales ratios suggest that the heat might be turning up, with the market placing a heavy premium on Apple's assets and sales. Even with soaring profitability metrics like their return on equity of 23.83% and an EBITDA leader with $32.5 billion, Apple is lagging in revenue growth, sitting at a humble 6.07% compared to a beefier 21.95% industry average. Basically, they might be driving the Ferrari, but they haven't figured out how to switch it out of second gear just yet. Still, with a stable debt-to-equity ratio, Apple's fortress seems well guarded, albeit looking to expand aggressively in some new directions. Now on to some hedge fund action. The billionaire chapter. Israel Englander, Big Cheese over at Millennium Management, a fund almost as profitable as my favorite pizza joint, recently decided to trim down his Apple holdings by 90%. That's right, he unloaded 11.5 million shares. Meanwhile, he snagged a major slice of the SPDR S&P 500 ETF trust, betting on a 180% climb thanks to what some call the Roaring '20s, aka the dance-off between macroeconomic giants and unprecedented productivity booms. Maybe he's got the inside scoop that dancing indexes don't come with cracked iPhone screens. Who's to know? Meanwhile, Apple's Pac-Man approach in China gobbles up talks with Tencent and ByteDance to elevate AI magic on their devices within the Great Firewall. It's strategic, yes. Necessary? Heck yes. Especially when competition in the largest smartphone market makes running with scissors look safe. Local partnerships might help fill the AI gap left by China's OpenAI ChatGPT hurdle. It's more than just surviving. Apple wants to keep thriving. Lastly, Apple and Meta take center stage in a Silicon Valley showdown. Imagine Tim Cook and Mark Zuckerberg at a tech WWE. The current round includes a good old squabble over interoperability demands under EU laws, prompting Apple to cry privacy risk. Meta fires back with the old Apple's exploiting privacy rematch. The news was all, in short, a tale of stocks, strategy duels, and market intrigue. Whether it's playing the stocks game right, trying to stay cozy with global partners, or battling competitors, Apple's in the ring, bright and early, every day. Whether they've got their bite in the right apple is for time to tell. Hey tech aficionados, let me fill you in on why automation tech company Symbotic is at the center of quite the hullabaloo today. Here's the deal. So, Symbotic, an automation technology company specializing in robotics and product movement, is facing a murky financial situation that's landed them in hot legal waters. Investors and finance analysts alike have been buzzing after a slew of lawsuits were announced following revelations from late November. What happened? On November 27th, 2024, it was disclosed that, oops, there were some serious errors in Symbotic's revenue recognition process. Specifically, the company admitted to discovering miscalculations regarding cost overruns on certain deployments that were not billable, hitting their financial outcomes right in the spreadsheets. For context, errors like these can impact revenue, income before taxes, net income, and even the good old gross margin. This financial slip-up sent Symbotic's shares plummeting by a whopping 35%, closing at $24 per share, and leaving investors gripping their armrests a bit tighter as their portfolios took a nosedive. And thus, the flurry of class action lawsuits began. Leading the charge, law firm Berger Montague filed a lawsuit on behalf of investors who snapped up Symbotic securities between February 8th and November 26th of 2024. Unsurprisingly, they were quick to pinpoint Symbotic's lack of internal financial controls as the culprit for these potentially devastating financial discrepancies. Enter another legal eagle, claims filer, who also put out a bat signal to shareholders, reminding those with losses exceeding $100,000 to file as lead plaintiffs. The lawsuits allege that Symbotic, along with certain company executives, neglected to disclose crucial information to investors, breaking some serious federal securities laws in the process. Piggybacking on this legal express were Bragar, Eagle, and Squire, making the trifecta complete by filing yet another suit. This complaint similarly highlights that Symbotic improperly inflated revenue recognition in its financial statements. With these alleged misstatements coming to light, the investors claim they've suffered damages. And that's a financial dumpster fire no investor wants to roast marshmallows over. The common theme among all these litigious happenings? and urging to assemble investors who bought into Symbotic to be appointed as lead plaintiffs. February 3rd, 2025 is the deadline set for filing these claims, so investors still have a bit of time to ponder their legal standings. One thing's for sure, Symbotic will need to navigate these choppy waters carefully as they attempt to rebuild trust with their investors and stabilize their stock market standing. It just goes to show that even in the tech-savvy world of automation and robotics, human error can still trip up the system. There's a watchful eye on how Symbotic navigates these lawsuits and restructures its accounting chops, because clearly the tech world never sleeps, and neither do stockholders with a thirst for answers. All right, folks, buckle up because today we're diving into the world of digital advertising in the stock market, all thanks to the Trade Desk. This company is making waves, and for good reasons. Let's see what has everyone buzzing. So, this year has been absolutely smashing for the Trade Desk. If you looked up their stock ticker TTD, you would see it rose by a whopping 77% year-to-date as of the end of 2023. That's right. You could almost say they've been having a gold star year, nestled happily in investor portfolios. For those of you who might be thinking you've missed the boat, the big question on the table is whether now is a good time to consider diving into their stock before 2025 hits. The Trade Desk has pretty much been the shooting star of the advertising tech world over the past decade. Showcasing double-digit growth rates annually since 2015, they've beefed up their revenue from a modest $114 million to a staggering $1.9 billion by 2023. And hey, they've been turning a profit since 2013, a once elusive unicorn in tech land. But what exactly makes the Trade Desk so valuable? These folks have a supercharged data-powered platform that amplifies advertising efforts across everything, from connected TV to mobile, audio, and more. Plus, they've been propping up advertisers with cool tools that help them plan, execute, and assess their marketing strategies, all in one neat package. In the financial world, they're knocking it out of the park, hitting a 27% revenue growth in the first 9 months of 2024. Their net income more than doubled, zooming from $82 million to a cool $211 million in the same time frame. Talk about cashing in. The kicker here is that they hardly scratched the surface of their market potential, considering they claimed less than 2% of the $830 billion global ad spend in 2023. So basically, the growth runway is looking more like an airstrip for some jumbo jets. To keep the momentum cranked up, they're riding notable industry trends. We're talking increased programmatic advertising, getting everyone off traditional advertising, and shifting to powerhouse connected TV. These trends are perfect tailwinds to the Trade Desk's massive growth sale. Then there's artificial intelligence, ramping up their Kokai platform and beyond. It's like handing their clients some super snazzy technological capes. Now onto the elephant in the room, the steep price tag of their stock. With a jaw-dropping price-to-earnings ratio of 217 times, we're having sticker shock as serious as a triple-shot espresso. This totem pole towers over even the likes of Alphabet's 26 times. So while risk-takers might find these valleys and peaks an alluring stock market adventure, conservatives might tread carefully here, given the razor-thin margin of error. Still, their business model and potential qualify them as a sledgehammer force in ad tech, and we'll be watching to see how this arena tugs between risk and reward. All right, tech enthusiasts, let's dive into what's cooking over at FIVN Inc. Now, if you're into the cloud contact center scene or dabble in investments, FIVN might already ring a bell for you. But today, they're not just ringing any bells, they're setting off alarm bells too. So here's the scoop. FIVN has found itself at the center of 2 class action lawsuits alleging violations of federal securities laws. Brought by Bronstein, Gewurz and Grossman, and Levi and Korsinski, these lawsuits claim that the company's executives tried to paint a rosy picture of their financial situation from June 4th to August 8th, 2024, a period now skeptically acknowledged as the class period. What exactly are they alleging? Well, apparently FIVN's net new business wasn't actually as strong irrespective of the macro as they'd claimed. Turns out, macroeconomic issues, think tight budgets and more discerning customers, were putting a serious dent in their revenue numbers. Investing being its own form of white-knuckle roller coaster, it seems FIVN didn't buckle up tightly enough. But wait, there's more. The lawsuits allege that FIVN had a booking quarter to forget, struggling with sales execution and efficiency issues. In simpler terms, their sales department was juggling without a safety net. Additionally, there seems to have been a bit of unwarranted optimism when FIVN forecasted a spike in their dollar-based retention rate. Picture a weatherman promising perfect sunshine on what turned out to be a rainy day. Should you have shed some dollars during this time frame, mark your calendars with a big red circle around February 3rd, 2025. That's your deadline to potentially be appointed as a lead plaintiff. There's no need to freak out if you're more of a background player than a spotlight kind of investor, as your involvement might still fetch you a slice of any financial recuperation pie. All right, folks, now it's your turn to shine. Have you been following FIVN's stock saga, or perhaps dabbled in trade during this tumultuous time? Maybe you're just here for the popcorn and the unfolding drama. Whatever it is, we want to hear what you think. Dive into the comments section below and let us know your thoughts. Do these lawsuits spell doom for FIVN, or will they shrug it off like a minor bump? Throw your opinions our way, and let's strike up a conversation about this ever-so-dramatic corporate tango on Wall Street's dance floor. Can't wait to read what you've got to say. All right, folks, let's talk about the trade desk, which seems to be the real rock star of today's tech news. A 77% stock climb ain't something you see every day. So, should I buy, sell, or hold? Cue the drum roll, please. I'd go with hold. Here's why. The trade desk is dazzling with phenomenal growth metrics and an impressive track record. Their revenue jumped 27% in the first 9 months of 2024, and net income more than doubled. Now that's the kind of financial performance you'd want an invite to. On top of this, they've cornered just a tiny slice of their potential market, meaning there's a whole buffet of opportunities left to feast on. However, a hold recommendation comes with a footnote, because of that hefty price-to-earnings ratio of 217. That's up there with the standouts at the Wall Street circus. And while high-growth stocks demand a premium, a PE this steep can make investors cautious, faster than you can say market correction. Let's not forget that navigating these waters is best left to those ready for a bumpy ride, like hanging onto a kite in a windstorm. Of course, don't just take my word on it. Always do your own research. Dive into those numbers, check out analyses from various experts, and match them up with your risk tolerance and financial goals. The stock market is more like an obstacle course than a stroll in the park. Prepare and strategize wisely. Oh boy, what a wild ride through the tech stock roller coaster today, huh? We've got Apple carving out epic strategies and battling it out in global markets, while Symbotic is trying to juggle some explosive financial revelations with multiple lawsuits breathing down its neck. Over in the ad tech world, the trade desk is shining bright, riding those sweet growth waves, but their sky-high valuation is sparking some serious debate. And let's not overlook FIVN, treading through its courtroom drama amid rocky sales estimates. It's the drama, intrigue, and suspense that can only happen in tech and finance. If you enjoyed today's summary, smash that like button, hit subscribe for a front row seat to all tech shenanigans, and don't forget to share the nerdy goods with your pals. Set those reminders because tomorrow we'll be back with even more tech tales to tell. See you soon.